Sure, yeah, this will be a very high-level overview of the SEC rules. For a more in-depth discussion, you can refer to the Dorsey and Whitney and KPMG memos that are included at the back of your spiral bond materials. So the SEC has adopted a three-step process relating to conflict minerals. Step 1 requires companies to determine whether they use conflict minerals in their products. Step 2 requires the company to look at the countries where those conflict minerals came from. And Step 3 requires companies to conduct due diligence on the source and the chain of custody of the company's conflict minerals. So when you work through the 3 steps, it's a very complicated process, and one useful tool that you could use is the flow chart that's also provided at the back of your materials. So let's just take a couple minutes to talk in more depth about each of the steps. The first step requires a public company to determine whether conflict minerals are necessary to the functionality or production of a product that they manufacture or contract to manufacture. The SEC believes that the meaning of manufacturer is reasonably understood, so as such, the rules don't define it. The SEC did provide some clarification that companies that only maintain, service, or repair a product containing conflict minerals will not be considered to be manufacturing the product. Whether a company will be considered a contract to manufacture a product will depend on the degree of influence that the company exercises over the materials, parts, ingredients, or components included in the actual product. Whether a conflict mineral is considered to be necessary to the functionality or production of a product will depend on the facts and circumstances. So everyone will have to spend a lot of time analyzing those issues. If the company determines that conflict minerals are not necessary to the functionality or production of a product that it manufactures or contracts to manufacture, then the company is done under the rules. No additional inquiry is required, no additional disclosure is required. But if a company does determine that conflict minerals are necessary to its products, it needs to proceed to Step 2 and conduct a reasonable country of origin inquiry to figure out whether those conflict minerals came from the DRC or an adjoining country. It's important to note that the SEC rules say that if you determine that your conflict minerals came from recycled or scrap materials, that they're not considered to come from the DRC for the purposes of the Step 2 inquiry. So Step 2 requires companies to conduct a reasonable country of origin inquiry. The key word here is reasonable. Companies are not required to prove with 100% certainty that none of their conflict minerals came from the DRC or one of the other covered countries. It's enough instead to just conduct a reasonable inquiry in good faith. And if after that inquiry the company has no reason to believe that its conflict minerals may have come from the DRC or the covered countries, or the company determines that its conflict minerals came from recycled or scrap materials, that then Step 3, supply due diligence, would not be required at all. All that the company would need to do in that instance is file the Form SD and briefly describe the process that the company went to in conducting its Step 2 analysis. If, on the other hand, the company determines that the conflict minerals may have originated from the DRC, then the company will need to move on to Step 3. If a company reaches Step 3, at a minimum, they're going to need to file a Form SD and conduct due diligence on the conflict minerals in its supply chain. In doing so, the company will need to follow a nationally or internationally recognized due diligence framework. The company's initial inquiry will focus on determining whether the conflict minerals are not from the covered countries or are from scrap or recycled materials. If the company determines that the conflict minerals are not from the covered countries or are from recycled or scrap materials, then the only thing the company needs to do is describe in its Form SD its country of origin inquiry, the due diligence measures taken, and the result. No conflict minerals report would be required in that case. If, however, the company determines that conflict minerals are from the covered countries or are not from scrapped or recycled materials, and we've passed the applicable transition period that I'll mention in a second, then the company must prepare a conflict minerals report and must have that report audited. The objective of the due diligence at this point is to determine whether the conflict minerals financed or benefited any of the armed groups. It's important to note that the SEC did give companies 2 years or 4 years in the case of smaller reporting companies to be able to classify products as conflict undeterminable, and for those products, then no audit would be required. So if a company has disclosures under the new conflict mineral rules. Those disclosures will go in a new SEC form. It's called Form SD. It's considered to be filed with the SEC and subjects the company to Section 18 liability. So those are the 3 steps, high level, in a nutshell.
Sounds pretty straightforward. Jim, so can I just make the assumption I don't have any of these and I'm done, and I don't have to do anything, don't have to prepare any documents?
Well, I think that what the rules do state, all publicly traded companies, the only industry that's scoped out, ironically, is mining. That's because there's Section 1504 in Dodd-Frank, which is specific for extraction issuers. That's why it was given a scoped out. However, with that being said, all industries would be impacted. The degree of impact would be different. You could have electronics, which is heavily impacted, versus financial services, which is very little impact. However, on the financial services side, if you take custody of gold as a custodian or trade the derivatives on tin, tantalum, tungsten, or gold, and take custody of those minerals as collateral, you perhaps are getting caught up in supply chain. So there are indirect and direct consequences as a result of what your business does. I think that, to Tom's question, if you do due diligence and you determine you do not manufacture or contract to manufacture, one could assume that you would stop right there. But I think we'd advise that you would at least have the records to support any assumptions that you come to avoid filing Form SD going forward. It does get back to the facts and circumstances and what your business does, but I think just because you're a certain industry, you come to the assumption that you're scoped out, we would not advise companies to do that.
Yeah, I mean, like I said, you are subject to Section 18 liability. So if you determine you don't have to disclose anything and you got sued because somebody thinks you should have, you need to be able to say that you, in good faith, didn't have any knowledge that anything was required, that you did not know that anything was materially false or misleading when you either didn't file the report or filed something in the report that was incorrect. So, like you said, you can't just do nothing. I mean, you really need to go through the process and document it so that if you do get challenged on it, you can, hang your hat on something.
And I think the 3 steps that Amy laid out, the further you get down the steps, the more you're actually going to have to disclose in Form SD. If you get caught up on step 2, reasonable country of origin inquiry, which could be quite easily for a lot of companies, you still have a filing requirement at that point in time, and that would be subject to Section 18, the liability provisions.
And I think it can kind of pop up on you. There's no certain percentage of this that you have to use. There's no de minimis standard on how much of this is. Is that correct?
That's correct.
Yeah, so, credit card strip?
It could be included. And I think that what we're advising a lot of companies is strategically high level. They need to do some sort of analysis to see where their exposure could be, and that's going to have, and we'll get into it later, a combination of different functions in companies. Obviously, you want your controllers or chief accounting officers group involved because of the filing requirement. Head of procurement, supply chain, it needs to be involved. Perhaps internal audit, perhaps legal counsel. You need to have all these functions come together to determine strategically what is your philosophy towards conflict minerals. That ultimately is going to determine how much effort you're going to put into this versus where your exposure is in trying to conduct it. One of the slides we'll get into is this is for calendar year 13, irrespective of what your fiscal year is. All companies are going to have to do something pretty quickly.